Hello and welcome to CIO Perspectives. I'm Sid All, the Co-CIO for Private Clients, Endowments and Foundations here at Brown Advisory, and I'm joined by my Co-CIO, Erika Pagel. We're excited to have with us today and welcome two more of our Brown Advisory CIOs, Sarge McGowan, the CIO of U.S. Endowments and Foundations, and Kif Hancock, our International CIO. As the year comes to a close, we're excited to hear their thoughts on 2025 and what 2026 may bring. Before we bring in Sarge and Kif, Erika, what's on your mind as we get ready to turn the page to 2025? What was the biggest surprise for you this year?
Thanks, Sid. It's pretty remarkable how the market has shrugged off tariffs as well as Liberation Day so far this year. The S&P 500 is on track to post high teens returns as we're sitting here today, up 18%. The top 8 names have accounted for 10% of that return. And then you've got areas like Europe, China, emerging markets, tech up more than 30%. And fixed income, the Bloomberg aggregate up 7%. So it's been a volatile year, but it's been a much better than feared year from a return standpoint. And we did start to see what a reversal may look like in November with tempered sentiment to the AI run up. And we actually saw value and some small caps outperform. So a few thoughts on my mind before I talk about a couple surprises. Number one, the Fed and rates. Much of the focus earlier this year has been on trade and tariffs. That focus has somewhat shifted more recently to interest rates and labor. The Fed just announced its third rate cut. Commentary pointed to a slower pace going forward. The Fed saying that rates are now within a range of their target, and they'll see how the economy performs before making any further cuts. But we've seen strong economic resilience this year. There's some areas of instability. CPI came in cooler than expected recently. Retail sales have actually been stronger than expected. Consumer confidence just recently dropped to April lows. And it seems like we are in this K-shaped economy that we've been talking about for a while, where some areas are seeing growth, but others are not, particularly lower and middle income are feeling the financial strain. So there still is upside risk to inflation, mostly driven by tariffs. Just remember, we've been above that Fed target for inflation for nearly 5 years. Any increase in unemployment and weakness in the labor market should probably impact the Fed's decision. There's areas like construction and manufacturing where hiring has slowed, but then we've also seen an increase in corporate layoffs, which I know we've talked on previous podcasts about this, but those layoffs are partly related to general restructuring, but also cost mitigation as it pertains to AI. Second, there's solid fundamentals that continue to buoy earnings and AI sentiment. Many of these mega cap firms have led returns this year, but they're on solid financial footing. I know, Sid, we'll talk about this in a minute. That large CapEx spending, that circular financing structure and associated revenues is causing some concern, and we still don't know what the return on invested capital is yet in its entirety. But AI spending, the boom, is also boosting economic growth, and we've talked a lot about how AI is propping up GDP this year. And then third, which I imagine Kif and Sarge will weigh in, is valuations are above historical ranges. Diversification still matters, particularly in a market where expectations are high in several areas. The S&P 500 and NASDAQ are once again at all-time highs, but current market valuations, you really need strong earnings growth to achieve higher returns following a double-digit earnings growth rate in 2025. The street is calling for that. Right now, it's up low teens EPS growth for next year. So I think one other area is there's been a lot written on, are we in this rolling recovery in earnings outside of tech? Estimates next year are for some of the laggards to have improved earnings growth in areas like industrials, utilities, consumer, and small caps. So we'll see how that plays out and relates to broadening of returns. Biggest surprise, clearly the magnitude and momentum behind AI, the CapEx spend. Some other surprises are rally in biotech. But I'd say the biggest surprise that I've seen is that the economy can actually handle a lot. There's been a lot of headwinds, and there continues to be. And, we've actually had a lot of resilience in the economy. Sid, I'll ask you the same thing. What's your biggest surprise? Where do you think we are in markets? Also, you've done a lot of thinking on AI. Are we in a bubble? Oracle's earnings announcement has caused some concern today. And how do you think this all plays out?
Well, there's a lot to unpack there, but first of all, I would agree with you that one of the bigger surprises was how well the economy weathered the tariff storm and many other things this year. But I think for me, still the biggest surprise was probably the speed and the adoption and really the growing usage of AI. Honestly, when we were entering 2025, I think it was more a curiosity, an area for experimentation. for individuals and companies, this was the year we really started seeing real use cases. A recent report from the AI initiative at Wharton suggests 80% of business leaders are using AI weekly. 3/4 of AI initiatives at businesses are generating a positive return on investment, and 90% expect to increase their spending on AI in the coming year. So we've kind of shifted from this age of experimentation to the age of implementation. And a huge driver of this is the increasing quality of the models. By the way, that's quality that most of our listeners won't even really be seeing because they aren't paying the $200,000 a year for the frontier models. OpenAI recently released some interesting data evaluating these frontier models on the performance on knowledge work tasks across 44 different industries. They were evaluating their performance versus humans. And a year ago, they were able to perform on par with professionals only 12% of the time. This year, that rose to 50%. A year ago, models were able to code instantaneously something that would take a human coder, 30 minutes to do. Now that's increased to being able to process a 3-hour-long task. So it's a 10x improvement. So it's kind of hard to underestimate this leap forward that we've seen this year. And we haven't even seen the models trained on the new NVIDIA Blackwell chips and larger clusters. We're expecting that sometime early next year. So for me, that pace has been incredible. And we know that coding has been a real area of efficiency gains. Microsoft and others have talked about AI doing 25 to 50% of their coding. You can now vibe code video games on Roblox and create studio quality short videos from text. But we also saw real world companies like C.H. Robinson, which is a logistics company, come out and say that their AI initiatives are driving real efficiency gains. They talked about a 6% increase in margins, 40% increases in the productivity per employee. This is all through automation using AI for things like more quickly being able to quote prices for customers and take orders and arrange delivery of their services. So AI is on the front lines, replacing much more of that time-consuming human work. JP Morgan talked about having an AI tool for reviewing commercial loan agreements that turned 360,000 hours of legal work into just a few seconds of AI usage. And then for me, closer to home, we've seen a huge shift in how we use it and how some of our external managers are using AI to quickly get up to speed on companies and industries, to help generate new ideas, to sift through huge volumes of information from company filings, podcasts, investment blogs. Right now, the usage of AI is doubling every 2 months. So the markets for both computing and power and data centers, they really seem to be in a shortage right now. And I'd expect that dynamic will persist in 2026. I think what was interesting about this year in markets is that leaders like NVIDIA and Broadcom, they did well, but investors were focusing more on the next layer of beneficiaries from AI. So companies like Siemens Energy, who manufactures gas turbines needed to power these data centers, or the neo cloud companies that offer this AI specialized cloud computing to plug the hole of this shortage in compute, or companies like SK Hynix that produce high bandwidth memory to service the increasing needs of these reasoning models. So what we're hearing from people deepest in this space is that while the pie is definitely still growing, the focus is shifting to the companies that are going to take an increasing slice of that pie. A great example of this is in the memory companies. So the next generation NVIDIA chips are going to require 10 times more memory. That's a huge shift in the supply and demand dynamics there. Additionally, there may be an increasing focus on which companies across software, gaming, industrials, financials, all sectors of the economy can differentiate themselves. You mentioned this on the use of AI. One area like software, it looks very cheap right now because investors are assuming that all these companies are AI losers, but that might not be the case. So I imagine the next leg of this trade in markets is beyond some of the obvious AI winners, the semiconductors and hyperscalers, et cetera. They could still do well, but I think they might not generate the best returns of all the AI winners. And that's exciting as an active investor. So hopefully the market's a bit less about the Magnificent Seven, a bit more about these less appreciated winners. And I'm hoping we start to see, as you talked about, some more meaningful improvements in labor force productivity, a boost to overall economic growth, and maybe some more tangible benefits from AI. I'm a little concerned about the job market for young white-collar workers. As a father of 3, we're already seeing some deterioration in hiring data, but I do feel it's a little early to say anything conclusive there. As you said, there's a lot going on in markets, but there's a lot positive, not just on the AI front, but interest rates coming down, growth in the economy being relatively strong, wages are growing faster than inflation, the consumer is pretty resilient. So overall, I would say I'm still fairly optimistic entering this new year. Enough from me. Let's bring in Sarge and Kiff. It's great to have you guys on. We're really looking forward to the conversation.
Great to be here. Thanks, Sid.
Let's start with you, Sarge. What's on your mind and what was your biggest surprise this year?
I'll piggyback on some of what Erika talked about because I think it's really hard to think about this year and not go back to April and where we were in the first couple of weeks of April with markets down double digits and meaningful concerns about tariffs. And in our world, in the nonprofit world, real concerns from our clients about what policy initiatives could do to their underlying businesses. You fast forward to today, and Erika stated a lot of the stats. We've got U.S. equity markets up mid to high teens. I think in some ways, even more surprising, non-U.S. markets up 20+%. Bonds have done well this year. And I think for me, it's just another reminder that it is very difficult to predict the path of markets. I don't think any of us sitting in the Baltimore conference rooms in April would have been thinking about what we would do with 20% plus market returns for 2025 at that point. And so that's also a nice grounding principle. It's a reminder that when we think about what we're trying to do for our nonprofit clients, we're not trying to predict the path of markets. We're looking to build portfolios that can generate very strong returns based on the risk profiles of each of those underlying clients and that can outpace a required return that can sustain the value of their endowment. So if you think about that as spending plus inflation, that's going to be in the 7 to 8% range. And that's really what we're trying to accomplish. So we're doing that with our clients this year. And so when I think about what's on my mind for next year, it's really around what do we do from here? Sid, you just laid out a number of the positives underlying markets. We've talked about valuations being high. And so on our mind is how are we going to be adjusting, adapting portfolios as we move into the new year?
Kiff, what about you?
I think I would build on what Sarge just said. I mean, we tell clients here all the time that we have no ability to predict the future with any bit of accuracy. And if we do get it right from time to time, certainly no repeatability. And as it turns out, we don't think anyone does either. So I think being humble about what may come, especially around this time of year, is always a prudent course. I think what's sort of surprised me most really recently is that, and these are discussions around London, that some have just come to this firm conclusion that we are currently in the midst of an AI bubble. We may be, we may not. I personally just don't have a firm belief one way or the other. When it comes to the most recent earnings cycle, there seems to be little to no evidence of any weakness in the AI story. NVIDIA, as you pointed out a minute ago, is innovating quite quickly. It's a stock that's become somewhat of the poster child for claiming irrational exuberance. But if you look at the valuation today, it currently trades on 24 times 2027 estimates. Of course, that depends on maintaining both growth and margins, and I have no idea if they will, but I do know that there are very smart people on both sides of the debate. So the point for me is this: I just think we need to remain humble. I mean, things are changing so quickly in this environment. If you think back just 6 months ago, very smart people were selling Google on the base case that it faced an existential threat at the hands of OpenAI. Earlier this month, though, OpenAI CEO Sam Altman told employees he was declaring a code red to marshal more resources to improve ChatGPT as it faced greater threats from Google. I just think who knows where things will be 6 months from now. Just being humble and adaptive in this kind of market environment and well-balanced is the prudent thing to do.
It's great to have your perspective sitting in London, and Europe has been one of the strongest markets so far this year. A lot of it's been thematic around areas like aerospace, defense, and financials. Would love to get your view on this growth, but also where things sit today and your outlook for next year on Europe and investing in Europe.
I'll piggyback on Jamie Dimon's comments a few days ago, and I've been saying this for a little while now, that I think Europe has a real problem. Just to put some numbers around it, and this is on a constant currency basis. So in 2005, America's overall economy was just 20% larger than Europe. It's now 45% larger. It's 91% larger on a per capita basis, up from 78% in 2008. If you take the UK, for example, if it were an American state, it would be either the poorest or the second poorest on a per capita basis, somewhere between Mississippi and West Virginia. And we sort of give that statistic to Americans. It really sort of opens the eyes. And I think Mario Draghi put it best recently when he said, for the past 20 years, slowing growth has been seen as a bit of an inconvenience here in Europe. And it's now becoming a bit of a crisis. And even if you set aside the standard headwinds caused by excessive bureaucracy, internal fragmentation, what you really have in Europe, I think, is a real issue with innovation. And it's really evident in the productivity gap between Europe and America that really began to separate, or America's productivity really began to separate in the early 2000s as sort of the dust settled from the dot-com boom. Here's another way to think of it. If you set aside Spotify, there is no European Union company founded from scratch in the last 50 years that has achieved a market capitalization over 100 billion. And without Spotify, which just surpassed 100 billion recently in market cap, there were none. And it's just another way of saying there are just no Apples, Microsofts, Googles, Metas, Alibabas, Tencents that are coming out of Europe. And to make matters more difficult, its historic strengths or areas of strengths, and those are advanced manufacturing and capital-intensive goods. You can think of the automotive sector, the chemical sector. They're facing heavy competition from China now as they move their way up the value chain. And that competition is only becoming more acute as energy costs here in Europe are the most expensive across the developed world. So it's being squeezed on both sides, China in the East and America in the West. And I think as a result, politics here seem to have become a zero-sum game. It's a fight for a bigger slice of a pie rather than making the pie bigger. And I think that's a big problem. So for me, the recent share price strength in defense of financials may alleviate some of the symptoms around the story in Europe, but I'm just not convinced that either are strong enough or have the means to really move the core issue of stagnant growth. And that's the issue facing Europe from my perspective today.
Yeah, thanks for your perspective. I mean, you're painting a picture that is a little bit mixed. I mean, a lot of our client portfolios have benefited from the strong performance in Europe this year. How are you positioning for some of those pockets of strength?
I know that wasn't very positive, and top-down macroeconomic headwinds are not mutually exclusive with really compelling bottom-up opportunities. And I do think that actually there are a lot of bottom-up opportunities across Europe. I mean, we're big believers in pockets where Europe does have strength. I mean, aerospace is one, defense is one. We've had a lot of success in European defense companies over the past 12 months. That probably has a lot of legs to the story. There are other areas of Europe with distressed investors, I know in the hedge fund world, that see a lot of opportunity in Europe. We definitely see it on the infrastructure space with respect to AI. There's going to be a massive demand for infrastructure across the continent. It has to be local, and some of the, I think, local players are doing some pretty incredible things that we find compelling. So a lot of the big thematic things that work in the U.S. are working in Europe. You just have to be very selective on, I think, the types of companies you're in and the types of managers you're partnering with.
Thanks, Kif. That's really helpful. Shifting gears a little bit, we've leaned for many clients into Japan over the past year. There's been a lot of reform that's been taking place in the region. How is that thesis playing out? And does Japan still present a good investment opportunity?
Yeah, it's a good question. I think we remain fairly constructive on Japan, if not very constructive. It's been said before, and I think it's become a bit of a cliche now, but it's worth repeating that the reform story in Japan is a story of evolution, not revolution. And I think for us, it's really about finding the right managers who can select the companies that will really begin to separate themselves from the pack. Those that are thinking about dividend policies, cash balances on balance sheets, return on invested capital, entering new markets, consolidating fragmented industries, all the sort of the tools at their disposal that I think in some ways are very common in the Western world, but are probably less common or less implemented in Japan. They're now coming to fruition. So we do remain constructive. But again, in my view, manager selection in Japan is very important. And that's what I think we're focused on at the moment.
Sarge, how are you thinking about international investments for some of your endowment and foundation clients? And how does currency play into that? How do tariffs play into that? What are the things are you thinking about?
We have always taken a global perspective with our endowment and foundation clients. And so international markets have been a big part of the story for a number of years, really for a couple of reasons. And I think tying back to Kip's comments on Europe, it's really not to take kind of a position on the UK economy or any other economy. It's really about diversification of returns and opportunities to find really skilled fundamental managers that may be operating in parts of the world and in markets where there aren't as many of them. And so those have really been the drivers for our focus outside the US. That's been in emerging markets, but really kind of predominantly Europe and Japan. We've been overweight these markets, I'd say more so Europe, the non-US markets for our clients generally over the past year or two. And that's really come from two drivers. One has been finding opportunities and finding people who we believe can generate high levels of excess returns for long periods of time in those markets. Japan has been been one that I have been close to for many, many years, and in a market that I completely agree with Kip that manager selection is critical, but there's this long, strong tailwind of corporate reform that I think is sitting behind those managers. And then we've also seen some of our global managers move more into Europe to take advantage of specific opportunities where they're seeing the same level of, or close to the same level of quality of company in areas like aerospace as they're seeing in the US, but at better valuations. So we are involved in these markets. We've been involved in these markets. There are a number of factors that we're constantly thinking about. On currency, it's been a pretty big tailwind this year. We don't really bake that in and expect that to continue, but it has been a nice benefit this year. For the yen, I think that's an area that the Japanese yen can provide some flight to safety protection in portfolios. It's one of the only other currencies other than the dollar that has historically done that. And so we don't mind having some yen exposure and have some exposure in the euro and other areas as well. So it's something we keep in mind. We don't have massive exposures to these currencies. Some of our managers hedge that out, but it is a factor we take into consideration. And on the tariff side, I think that really is almost more company by company. A lot of the companies our managers are investing in, when I think about Japan in particular, they really tend to be more domestically oriented and so maybe not as impacted. But we do need to pay attention to tariffs as we think about economic growth for countries and how that could impact the economic cycle. I would say, if you just think about China as probably the most impacted, it's one of the strongest equity markets this year. So it's just one of many factors that we're thinking about.
Sid, you touched a little bit on this in your opening comments, but I'm curious to hear more about the view from the U.S. and specifically on AI and how much it's really impacting economic growth. A minute ago, I shared some views that I think that some fear there's a real AI bubble. Maybe there is, maybe there isn't. Just curious your views on, is there a bubble that's fit to burst in the coming year, and just how you're thinking about the valuation perspective?
Yeah, I guess I kind of dodged that question from Erika earlier on. So thanks for bringing it back. You may have gathered from my intro, but my views, I guess, would be if we're in an AI bubble, we're probably still in the early or middle stages of it. So I noted how much AI usage is exploding, AI revenues are growing incredibly quickly, and these investments into AI infrastructure still feel pretty firm at the moment. I know you said something similar, right? I mean, these companies are not lowering their expectations for spending, they're increasing them. I do take some comfort in the fact that we're really nowhere near the 1999 levels for valuations in the big tech companies. So, the top 10 companies are trading at roughly half the price to earnings ratios we saw in 1999. The IPO market isn't going crazy yet. There's some interesting news about SpaceX and OpenAI considering going public, but we've still had a pretty muted IPO market. Debt levels at the company level are way lower than they were in 1999. So the S&P 500 had a 4 times net debt to EBITDA leverage level in that period, and we're at kind of 1.5 times, so much lower today. And then the companies in the S&P 500 are spending less of their free cash flow on capital expenditures. It's about 50% of cash flow going to CapEx today versus 75% in 1999. So this build out still feels like it's not reached telecom levels. So without a doubt, I think we've entered a riskier phase of this. The dollars are getting bigger, more funding from these projects is coming from debt. There are these well-publicized circular relationships between companies like NVIDIA and OpenAI and the other players in the space. And I wouldn't downplay that, but I think part of what NVIDIA is doing is very logical. So they're going to generate nearly $100 billion of free cash flow this year. They have $50 billion of net cash on their balance sheet. They are printing money right now. So investing that back into the ecosystem makes, I think, a ton of strategic sense when they're seeing this usage of AI spike the way that it is. I'd also note that even after all of the increased plans for CapEx from the big tech companies, when you subtract that, the big tech companies are still going to generate $150 billion of free cash flow next year. So as for how much AI is contributing to GDP, I think we would say it's likely at least 25% of U.S. economic growth. It could be as high as 50%, depending on how you calculate it. So it's definitely having a big impact. So while I might have a near-term positive view on AI and the companies at the center of it, the U.S. economy, and for sure the U.S. stock market, is increasingly tethered to this one theme. So we as investors, I think we have to take that into account when considering diversification in portfolios. So what Sarge was just talking about, that layer of diversification internationally, what you've talked about as well, the currency diversification, those are really important because this is the most concentrated market we've seen in our lifetimes. It's more concentrated than the late 90s, than the 60s. So even if we have this positive view, we have to be disciplined in terms of our exposure to it. Kif, back to you on AI. I mean, you've talked a little bit about your views and don't have a particularly strong view. Are we in a bubble, not in a bubble? But what are other investors in Europe saying about AI? And what are you seeing in terms of the adoption of AI at the company or consumer level from Europe?
I think it's the adoption side that creates, I think, the greatest hope or bull case for Europe in the near future. And I talked about sort of the lack of productivity, that everyone in Europe recognizes that AI could be the solution to this massive productivity problem that Europe has. It's not just a productivity problem, but it has a declining population problem as well, much more so than we see in the United States. And I think so much of the AI story, at least up to this point, has been focused on what some call the installation phase. And that's all the infrastructure that goes into it with hyperscalers, the data centers, the chips, the power, all the things that are behind the actual models. And then there's the deployment phase, for lack of a better description, which is taking the actual models and the other things that AI can do and creating more efficient ways of providing both products and services. And I think that's where the lag, which historically has been pretty wide between the installation phase and the deployment phase, I think is being sort of condensed because we're already seeing industrial companies implement AI to make trucking routes more efficient, to get higher throughput, to make back office processes more efficient, to just remove a lot of the waste. And I slightly sort of tongue-in-cheek referred to sort of the bureaucratic gridlock across Europe, but I think the optimistic sides of it is there is a lot of low-hanging fruit that AI could be implemented quite quickly to create a real productivity enhancement across the European continent. And if it is successful, where valuations are today, I think you can make a bull case if you're very selective of finding the companies that are the early adopters, that you can find a lot of opportunity in Europe. And I think that's where, I know we'll repeat this several times today, manager selection and finding those managers that are looking at the companies that are adopting AI are probably in just as good a position as those managers that we have that are behind the Googles, the Microsofts on the installation phase. So I want to balance out some of my more cautious comments earlier where I do think there's a real opportunity on this side as well.
Sarge, just rounding it out, what are your thoughts on this whole AI discussion, bubble talk, and how are you approaching investing?
Yeah, there's still just so much we can't know at this point. Your comments around the leaders to date being kind of different profile of company than what we would have seen in the late 90s is really important. These are great companies. They're very profitable. They're spending a lot of money, but this is cash that for the most part they have and they can cut off if they need to. I think understanding what the return on investment will be there is still a question mark. Understanding how this broadens out, we're starting to see it this year, as you've noted, seeing how it broadens out beyond the mega cap hyperscalers and some of the semiconductor players to different parts of the value chain, and then increasingly potentially into corporates and opportunities on that side just for the general economy. So I think there is a lot we don't know here. And the only thing that I'm pretty confident of right now is that the market doesn't know how to value this either. I think Oracle is a great example. Even before the sell-off today, Oracle, as of yesterday, was actually down from where it was prior to the $300 billion announcement with OpenAI. So it was up 30% almost immediately and has given all those gains back. And Kif also talked about Alphabet earlier and how that stock has worked its way through this year. We just don't know how to value some of these things yet. And some of the changes could be so existential that it's really creating big disruptions in prices. And so, again, I think finding people who are close to this topic and who can really invest around it is always important and is certainly important right now. We've taken a couple different approaches here to this part of the market. For some of the largest companies, we're getting some of that exposure through either passive exposure or through alpha extension strategies that give us some of that passive exposure, but with some excess return on top of it. We have also looked for managers who we think are particularly good in this space and are continuing to put capital to work with a couple of those. And then I think to balance it out, we're more broadly thinking about other types of opportunities, something that we've always done in terms of diversification across different markets and different strategies, looking for places in private markets and small caps outside the U.S. portfolios and strategies that we think can do well in markets that aren't going to be really solely driven by AI. So a bit of a barbell approach to this.
I think it's really interesting, the comment you made on Oracle, because I think in some ways, the price action in Oracle earlier this year, the price action in Google, or even just some of the last couple of months when some of the high-flying AI winners have sold off a bit, in my mind, I see that as a very healthy skepticism that still exists, which is another case to be made for us not really being in the late stages of a bubble, because there's still, as you say, a lot of consternation about this, a lot of questions about how to value these companies. And I think that is quite healthy in many ways. Erika, with this year being all about themes, the AI theme, the aerospace theme, banks coming back, it's been a tougher year for just run-of-the-mill quality investing around the globe. And clearly a lot of the strategies, the active strategies that we prefer, have this quality orientation. How are you thinking about that dynamic in portfolios? And could you also touch on how passive linked strategies play a role given the heightened levels of market concentration we were just talking about?
Yeah, I think you're right. There's these two things that are happening right now. You've got quality managers. So these are managers that have earnings, return on invested capital, cash flow, and healthy balance sheets, growing dividends. And in many asset classes, many quality companies, many quality investment managers have underperformed risk, have underperformed speculation, momentum, and tech this year, as well as equity benchmarks. And then, on the other side, you also have, which is related to what Sarge was just saying, this greater interest in passive investing. So for quality, much of it has to do with exposure to mega caps, those themes that you were talking about, the top winners this year, and sizing around those positions. But a lot of it is truly on stock selection. So if you weren't in the right names in each of those themes, there is a pretty good chance you are underperforming your benchmark this year. And with so many higher valuation companies experiencing strong performance, it's been a really challenging environment for managers that are looking for companies that have attractive long-term value propositions, but are also focused on quality investments. And we talked about this a lot in our last podcast with Jordan. If you look at various asset classes, so take the S&P 500, the highest multiple stocks, they've got the highest returns so far this year. Within small caps, roughly 40% are non-earners. Those non-earners are significantly outperforming companies for the most part that have earnings. So again, a really difficult environment. So it's just been this tug of war between momentum and quality. Momentum has clearly won. And look, there's another side too that plays a role here outside of AI, and that's liquidity. So there's been enormous bidding up of unprofitable companies. Some are AI related, some are not, on the premise that you're going to have lower borrowing costs, improving balance sheets. So I think it's really important to note that we still believe in quality investing over the long term. If you look at quality historically, quality's outperformed in many markets and provided good downside capture. On passive, look, I think it's a balance, particularly in less efficient asset classes like U.S. large cap growth. Remember, with active, you're hoping to beat the benchmark. With passive, you get everything. You get all this concentration right now, good or bad. You get the movements that we were just talking about in Oracle. So we're not striving to have a similar level of concentration to benchmarks right now, but we also don't want to be unintentionally underweight these mega cap companies. So for clients that want AI exposure or to reduce that mega cap exposure gap, if you will, versus the benchmarks without changing their overall risk profile, without changing the portfolio beta, we have used a lot of tax advantage strategies that have lower tracking error, will give exposure to a lot of these mega cap companies and themes. And we've also added in passive strategies to portfolios. So I think that we just have to be really mindful that we've seen so many shifts over the past year. It's likely we're going to see more shifts in market leader dominance and performance. So we just want to make sure that there's balance within this environment. And we're spending a lot of time focused on portfolio risk as we add in these more lower tracking error passive strategies into portfolios. Sarge, I'll ask you about this dynamic. I know you've used many of these strategies. You just touched a little bit on alpha extension. Are we setting up for a period of better returns for quality-focused investments?
I wish I knew. I think as fundamental investors, we believe that prices will ultimately follow earnings and cash flow. And the timeframes that plays out over can be very different in different markets. But ultimately, we're all going to have to do some deep thinking if that stops working. And so I think that with that premise, if we are invested in quality companies that are growing and generating earnings, we will be rewarded for that. And so that's something that I believe deeply, and I think we probably all do. And so we are continuing to invest in these strategies and in these companies. When I think about what sort of happened this year, I think there are, again, a lot of very big questions for software companies, for other parts of the market where we just don't know what AI and things like digital currencies, if you're thinking about a company like Visa, like what some of these impacts will ultimately be. So far, we're not really seeing these things play out in the numbers for these companies. And so we have managers that are invested in some of these in the software space, like Salesforce, and in companies like Visa. And we've seen some multiple compression. I'm not sure we're at a spot where that is at deeply discounted levels. I think what we're more in places where the multiples are below long-term averages, they're not at all-time lows. And so I think when I think about that, I really don't know how this plays out, obviously, from here, but where we see opportunities, I think that these can be good opportunities for investment and kind of looking for opportunities for more sell-off and potentially great opportunities here.
If turning to you, another topic of focus has been private credit. There's been a lot of fundraising in this area over the past couple of years. How are you approaching investments in this space, given a lot of recent headlines? And how are you investing in private credit for international portfolios?
Yeah, private credit's an interesting one just because I was in Asia a few weeks ago speaking to both prospects and clients, mainly in Singapore. And we didn't talk about really the AI story all that much. I mean, we certainly did, but it wasn't the first, second, or even third question, which I found very interesting. The first question was, what are your views on gold? And do you think the rally in gold will continue? And I found that quite fascinating. But the second question was, do you think there's a bubble in private credit? And I heard that consistently across the region. And my response was that we certainly have some concerns regarding the amount of capital flooding into the space. I mean, a lot of strategies are coming to market quite quickly. A lot of teams with perhaps a lot less experience than others are launching private credit strategies. And I think we are cautious, rightfully so, like we are in every asset class. But I think we're especially cautious in strategies that compete with the banks in the broadly syndicated loan market. But again, it's just not as simple as that. It's more nuanced. And we think with partnering with private credit strategies today, experience matters, the size of the strategy matters, who you're invested alongside with in a structure matters. And we've seen some of those play out in public markets recently. Transparency matters. So when you put all these criteria together, and not to be redundant, I think that manager selection really matters in the space. I think there are pockets of private credit that we are still quite constructive on. And there are a subset of firms that continue to offer, I think, a compelling opportunity, especially for tax-exempt clients that have an income requirement. So like anything, I think we remain constructive if we understand what we invest in, like Sarge alluded to earlier, follow the fundamentals, the cash flows, and the valuation will follow. But that's the job of sort of parsing that out and finding the nuance there and sticking to it.
Sarge, back to you. What are the main areas that endowment and foundation clients are asking about today? And what are you focused on in portfolios for these clients?
On the portfolio side, a couple things. First and foremost, we are always on the hunt for great investment ideas. And that is what our team is doing day in and day out. We are in the midst of investing in a manager on the public equity side who is a generalist, long-only manager, concentrated portfolio, has invested across many industries in the U.S., but has done quite well. I think been very close to some of the hyperscalers and semiconductor players. And so that's an area we feel really good about as we think about the AI discussion we had earlier. So we're busy on that front. We've been busy on the private side with a couple of opportunities in buyout and in real estate. And so first and foremost, bottom up focused. On the portfolio side, We are in the midst of gradually rebalancing. After a year like this, our equity exposures have gone up and just looking for opportunities to cut back that risk a touch, as we've seen some extension in that given the market and some of the performance we've had this year. In terms of what we're spending time with on our clients, I'd say a couple things. The first is around the discussion around passive investments in equity markets. I mean, this is a time that you get a lot of questions about should we just be all passive or more passive? And we think that there's certainly a place for passive exposure in portfolios, but really try to talk to our clients about the concentration in those indices and sort of lack of diversification and why that role should be somewhat limited inside their public equity portfolios. On the private side, our third quarter meetings with our clients, we pick a topic each quarter. In the third quarter each year, we go through private equity. And our message here is that consistent investments across privates are incredibly important. You need that vintage year risk. It takes private managers multiple years to call down capital. There's just really no way to try to time private equity investments. And so having that consistent investments and across a broad range of strategies, whether it's venture, growth, buyout, real estate, real assets, just having a plan and kind of sticking to it to build that long-term exposure. And then the last thing, we spend a lot of time with our clients just talking to them about their long-term needs and really trying to build these portfolios in a way that we can accomplish that. That is not about beating a benchmark or beating the nonprofit institution next door. It's about generating returns that can allow these pools of capital to last into perpetuity. And so that's our focus, and it's something that we're always spending time with our clients on.
Maybe we can try to end things on a slightly different note, and we're going to have a little bit of fun here. Let's talk about, go around the horn and hit a few ideas that we're excited about for 2026, but also maybe an unexpected surprise, positive or negative, for the year coming up. This is in honor of our colleague, Eric Gordon, who couldn't join us today, but is about to share a piece with his thoughts on this topic, which will be on our website. Sarge, you want to kick us off since you have the hot hand?
Absolutely. Yeah, the thing that I am interested to see in 2026, and I think could be a surprise, but I'm a little cautious on this because we've been saying it for a couple of years, is that we could see a real increase in exit activity on the private equity side. The market conditions are pretty ripe for it. We've had a strong period of public market returns that's been led, as we've talked about, by technology, which is what a lot of these companies are in the private market, particularly in venture capital and growth equity. And private exit activity has not been as robust in the last few years as it normally would be. And so there is this built up supply of companies that could come to the IPO market, could be sold to strategics. And I think 2026 is really building up to be a year where we could see that. SpaceX came out, I believe it was yesterday, and talked about IPOing in 2026. We've heard about OpenAI potentially IPOing in the not too distant future. These are the bellwethers in the private markets on the growth side. So I think if they were to do that and we're successful at it, I think we could see a real opening up of exit activity, which would be great news for private managers and for the investors in those funds.
Totally agree. And man, our investors desperate for that outcome, Sarge. So I hope for all of our cases that you're right. Kif, what about you? What surprises do you think we might have in store this coming year?
I agree with Sarge. I mean, I think people have been so down on private equity for 3 years due to the lack of liquidity, but we've also seen just stagnant valuations as EBITDA growth in the space has continued at a pretty healthy pace, but you've had multiple contraction because of higher rates and higher debt levels with less liquidity. So I think private equity could be poised to have a pretty positive year. The other thing I keep an eye on, getting back to how we started, is I wouldn't be surprised if we still see heavy market concentration continue to lead going forward. I mean, looking out to 12 to 18 months, I was just speaking to our tech team right before we jumped on this, and they say over the next 24 months, the insatiable demand for the products and services of the hyperscalers and the NVIDIAs is just continues to be there. So I wouldn't be surprised if we face another year of just market concentration and leadership with names we've all been fairly accustomed to speaking about on a regular basis. I wish I had a better answer than that, but it may continue.
Erika, what about you?
Yeah, I agree with Kif and Sarge, and likely we're going to have more of the same. I do think that we're going to see the AI capital spending start to benefit other industries outside of tech, which should hopefully support a broadening of returns next year. plus easier fiscal policy as well as monetary policy should help to support growth. So hopeful in that manner. I guess one other fun area, we're probably going to hear a lot more about robotics, and we'll see if robo-taxis actually come to fruition. Sid, what about you?
Man, robotaxis is a good one. I'm not sure if 2026 will be the year, but it feels like 2026 may be the year that people really start focusing on it. I mean, it just kind of makes all the sense in the world that if the technology is there, that if you can reduce accidents and save the tens of thousands of lives that are lost every year in automobile accidents, that we may see a big share gain there. First, the things I'm excited about these kind of next generation AI winners. I'm still very excited about the opportunity in Japan. As Sarge mentioned, still excited about allocations to traditional middle market buyout in the private equity world. I love that we're leaning in when a lot of other investors are pulling back and it's taking longer for these firms to raise capital. But as for a surprise, it kind of rhymes with yours, Erika. So I think we may be surprised at the strength of the U.S. economy. We have rates coming down. We have a relatively unlevered consumer and corporate sector. We have relatively manageable inflation. We have wages rising faster than the rate of that inflation, and we still have a pretty big fiscal impulse. So, government running a pretty big deficit. So this renewed cyclical strength could bring about a broadening of market winners. We could see strength in some areas that have lagged, like housing and real estate. Maybe even, Erika, some small cap stocks getting a little bit of a bid. And I think this economic strength could come in the face of weakening job numbers. And some of this may be AI rather than a sign that the economy is weakening. And other areas that I think could benefit, Sarge noted this, I do feel like it could be a big year for software stocks, which have been pummeled, and the more quarters that they can report solid earnings and perhaps even some growing AI-related revenues, the more investors will be forced to re-rate them. So some of those areas that have been some of the biggest losers in 2025 could be the biggest winners in 2026, but we'll have to see. Well, we covered a lot of ground. Guys, thank you so much. Sarge and Kif, we'll let the two of you get back to doing what you do best. Thanks for coming.
Thank you.
Thank you.
I also want to thank all of our listeners on behalf of Erika and me who have been tuning in this year. It's really a pleasure to get to do this. We're looking forward to sharing more in the year ahead. And for anyone interested in learning more about our thoughts on the surprises of 2025 and predictions for 2026, do take a moment to go to our website and read Eric Gordon's Equity Beat article, which is published there. Thanks again, and we'll see you on the next one.